Let me introduce you to the recently optimized zero-sum G strategy here at 0SPX Auto Trades. Think of it as a safety net for your portfolio. It's designed to protect you from the unexpected while still giving you room to grow. With these latest improvements, we've fine-tuned the strategy to handle both calm and chaotic markets even more effectively. Let me walk you through how it works. Imagine you've just bought a house for $100,000 and you're excited because you believe its value will grow over time. Maybe it'll increase by about 5% each year, so in a year, it could be worth $105,000, a nice gain. But just like with any investment, there's always a risk. What if something unexpected happens, like a fire, a storm, or some other disaster? Without protection, your $100,000 investment could be wiped out. This is why people buy home insurance. Let's say it costs you 1% of the house's value per year, or $1,000. That $1,000 is a small price to pay for the peace of mind that no matter what happens, your investment is protected. But what if your house doesn't grow in value as fast as you'd hoped? Maybe this year the housing market slows down and your house's value stays flat. Does that mean you can skip paying for insurance? Of course not. Your insurance is still a necessity because it's not just about protecting you in good times. It's about being prepared for the bad times too. Think about it like this. While your yearly insurance policy might cost $1,000, you're likely paying that amount in smaller monthly chunks, maybe around $83 a month. During slow months when your house's value isn't increasing, those $83 payments might feel like a drag. It might seem like you're spending without getting anything back. But here's the big picture. You know that, over time, the value of your house will rise, even if it's not happening right now. And in the meantime, your insurance is protecting you from catastrophic losses. So, whether your house is gaining value quickly or moving slower than expected, your insurance keeps you safe, ensuring that when the growth picks up again, your investment will still be intact. It's not just about short-term wins. It's about securing your long-term success. Now think about how this idea of home insurance applies to protecting your investments. Instead of a house, imagine you have a portfolio of stocks or other assets. Just like a house, your portfolio can grow in value over time, but there's always a chance something unexpected could happen, like the market dropping suddenly. To protect against that, investors buy something called put options. These work just like insurance. When you buy a put option, you're paying a small premium, just like paying for home insurance. In return, it protects your portfolio from big losses. If the market drops, the put option helps you recover some or all of the lost value. And just like with insurance, you'll never pay more than the agreed premium. Here's the catch. Just like paying your monthly home insurance bill, put options also lose value over time if nothing happens. This is called decay. It's like how, during a slow season, your house isn't gaining much value, but you're still paying your insurance premiums. It might feel like you're losing money, but you know the insurance is there to protect you if something goes wrong. If you want to learn more about the technical aspects of this strategy, read on. Another factor that can affect the cost and performance of your put options is volatility. Volatility measures how uncertain or unpredictable the market is. When markets are calm and steady, put options or other types are cheaper because there's less perceived risk. But when volatility rises, such as during periods of uncertainty, fear, or market sell-offs, the cost of put options goes up because more people want to protect themselves. This volatility effect also means the value of your put option can change, even if the market doesn't move. For example, if you bought your put option during a volatile time when it was more expensive, and then the market calms down, the value of your put option can drop quickly. It might feel like you're losing money faster than expected because of this drag. But remember, just like home insurance, the purpose of your put option isn't to make money. It's there to protect you in case something goes wrong. So, even if the value of your insurance seems to decline during calm periods, that's okay. Your goal is for your long positions to grow over time, and the put option is simply your safety net. This balance of protection versus cost is what makes put options such a powerful tool for hedging risk, even when market conditions aren't moving in your favor. When you buy put options as insurance, the The premium you pay represents a cost that can eat into your profits if the market doesn't move enough. That's why it's crucial for the market to move up, whether moving up or down, to move significantly enough to offset this cost. Let me explain. If the market moves quickly upward, if the market rises fast, the gains from your long ES position can easily outpace the cost of the insurance premium. So here's an example. Let's say the premium costs $100,000, which is 10% of your portfolio value, and the market rises 300 points. With 15 ES contracts, each point is worth $50. Multiply that by 300 points, and your total gain is $225,000. Subtract the $100,000 premium, and you're left with a net profit of $125,000. In this case, the market moves fast enough to cover the premium cost and still deliver strong profits. The faster the market rises, the smaller the impact of the premium on your overall returns. If the market moves quickly downward, now, let's consider a sharp market drop. If the market falls 300 points, your long ES position loses value. A 300-point drop with 15 ES contracts would result in a loss of $225,000. However, your put options gain value as the market drops, offsetting that loss. Once the market falls past the 150-point break-even mark, the put options not only protect you, but also start generating profit. After accounting for the $100,000 premium, you'd still be left with $125,000 in net profit. The faster the market moves down, the sooner your put options cover the premium and begin adding to your bottom line. If the market moves slowly, here's where the challenge comes in. If the market moves too slowly, either up or down, the cost of the premium can eat into your returns over time. For example, if the market rises only 50 points, your ES position gains $37,500. Subtracting the $100,000 premium leaves you with a net loss of $62,500. Even though the market moves in your favor. Similarly, if the market falls less than 150 points, your put options won't fully cover the premium, and you'll still end up with a loss. Why market speed matters. When the market moves quickly, whether up or down, it generates enough momentum to offset the cost of the premium. On the upside, faster gains make the premium feel negligible. On the downside, the put options increase in value more rapidly, protecting your portfolio sooner and minimizing drag. If the market moves slowly or remains flat, the premium becomes a drag, reducing your returns without the benefit of large price movements. The big takeaway for this strategy to be effective, the market needs to move decisively, either up or down. The faster and farther the movement, the easier it becomes to overcome the cost of the premium and realize meaningful profits. Even when movement is slow, the insurance is still worth it for the peace of mind it provides, knowing your portfolio is protected against the unexpected.